Hey everybody, Paul here coming at you with a great video that will be a supplementary video for yesterday's Crypto Coffee update, February 17th, 2019. A user left a comment with some fantastic questions pertaining to 51% attacks that we covered, and I think it might have been a bit of a tongue-in-cheek joke about some of the difficulties of all the terms we use. It's very technically complicated. However, I want to use this video as an illustration mechanism today to help to show realistically, once you learn the terms, it's not that complicated at all. A lot of this is analogous to many things we deal with in our everyday life, especially now that most of us have smartphones. We're using computers day in and day out. So let's go ahead and jump in and get these questions answered. Shout out to that user as well. Going to give him another one towards the end of the video. But the first question is, what is a node? A node is any system or device connected to a network. Boom, simple as that. So realistically, anything on a shared network. In this example, a file server is used, 2 printers, and 5 computers. So a total of, there we go, 8 separate devices connected to this network. Now, your printer, it can't order you food off Amazon. It can't update your Facebook status. It has a specific function. And computers, they can do all that and more. So you have 2 separate types of devices that share a network and communicate with one another. Now, they don't do the same thing, so you may be wondering, how do these 2 very different devices that share a common network communicate? This is through a set of rules and instructions that each computer follows, and that is a protocol. So a protocol is, again, a set of rules or instructions that each computer follows to ensure that the communication on the network is fluid and that there's nothing lost in translation. Perhaps it could be best conceptualized as some individuals who speak French, some individuals who speak German, and individuals who speak Italian. Maybe they all agree on English or Latin as the language that will serve as a protocol for communication, or a set of rules used to dictate how communication occurs on a shared network. In the sake of language, a social network. In the case of computers, a protocol, it is going to be a specific digital set of rules or instructions. Cool. So now we know that nodes, which is any device on a network, they use protocols to communicate with one another. Now, Bitcoin being a software, it has a protocol, which means that any node on the Bitcoin network must follow a certain set of rules before it can actively participate in the network. Now, you can see here, it is a huge list of various rules for various types of nodes, and we're not going to go into all the details here today, simply because not only is it a lot of information, but I'm not technically qualified really to go into all this. Full disclosure, as you probably know if you follow Cryptide, I'm not a programmer. I'm a researcher. I'm a data aggregation specialist. I wear a lot of hats. I do a lot of things in this space. However, when it comes to programming, I know a little bit of Python. It's all I can do. So I'm not going to do anyone a disservice by giving them incorrect information or giving them information that is so basic about such a complicated point that if extrapolated from, it could be a danger. So this is really, again, a back to basics thing. So Bitcoin, it's a software. It has a set of rules through which the various nodes or devices on the Bitcoin network communicate. That's really all we need to know for today's explanation. And to help drive that point home, here's a collection of the Bitcoin nodes all around the world. You can see down in India, we have a collection of nodes, and a much darker hue of blue up in Western Europe. Let's go ahead and zoom into Western Europe. And you can see Paris, London, Belgium, we have a lot of them in Western Germany. All of these represent individual nodes relative to the size of the circle. So you could see there's a lot of nodes here, a lot of nodes here, a lot of nodes in high concentration here in Belgium. And if we zoom back out, here we go again, you can see all around the world, all of these nodes. Now these nodes are independent of hashing power. That's another question. What is hashing power? And we'll get into that momentarily. But just to wrap up the nodes on the Bitcoin network, here are all the individual nodes all around the world. We'll use this in a future example, so we'll come back to this. Now, I said the next question is, what is a hash? And a hash is simply a function that converts one value to another. Now, why is that relevant, Paul? Well, hashing, as you can see here, is a natural fit for cryptography, because it masks the original data with another value. So it's almost like a math puzzle, right? So in the Bitcoin protocol, there is a use of hashing or hash functions that actually take the shape of kind of like a mathematical puzzle. It's like flipping a coin. You try and solve the puzzle, you either succeed or fail. Try and solve the puzzle, you either succeed or fail. And you continue that action as many times as possible using your computer. Now, when you're doing that, it's taking physical energy in the real world. So actual physical stuff, plug it into the wall, get your computer running. Awesome. It takes energy. And you're doing a action of labor by trying to solve this mathematical hash. So you're proving the fact that you're working on this hash. Proof of work. We've heard this before, right? So proof of work is intrinsically related to hashing in the crypto ecosystem, Bitcoin specifically. We're going to be sticking with Bitcoin for the entirety of this technical segment of the examples. Now, hash power or hash energy, proof of work, having to put in physical energy to solve these mathematical puzzles, that is the act of mining. Because when you're putting in this energy to solve these hashes, you are doing the act of mining Bitcoin. Or when you solve these hashes, if you do so successfully, first you receive a reward for your efforts. So this is a competition with all shared rules via the Bitcoin protocol through which individuals solve hashes doing the act of mining in an effort to receive a block reward. So that's very interesting and exciting. You have computers all around the world following the same sets of rules, attempting to gain a reward, and in turn they are proving that they are working and contributing to the security and resiliency of the entire Bitcoin network at the same time. So in this example, by defining what a hash is and what hashing power is, hashing power being the real world energy being input into solving these hashes, we can begin to see the ingenious nature of the Bitcoin system and how digital ledger technology is truly a fantastic human innovation that has led to an outcropping of subsequent innovation in the crypto space. Interestingly enough, there have been some reports about, well, all this energy, it could be put to better use. I think maybe we could perhaps even accelerate global warming and destroy the planet if we keep putting all this energy into simple crypto mining. Well, it turns out that this individual, Robert Sherratt, he goes into a lot of these claims and breaks down how Bitcoin mining actually is one of the greenest industries, disproportionately by a huge margin utilizing renewable energy from renewable resources, given that many times segments of renewable energy lies latent until accessed by very flexible pieces of hardware. And what more flexible piece of hardware than Bitcoin mining? It's global, it's energy input agnostic. You can put any energy into the system and it'll work just fine. So very exciting stuff there. And now we can see what a hash is and what subsequently hash power is, which is the amount of energy being put into solving these cryptographic puzzles for a chance to receive a block reward or a reward in Bitcoin. Now, what is a block? We just described how the system secures data. We just described the rules that it follows, but how does it order this data? What are we trying to solve and how are we putting this data together? Well, a block is the mechanism and the method by which data is assured after these puzzles are solved. So I think it's best conceptualized as an actual package. When you fill up this package, you seal it and you send it off. So it's good to go, it's nice and secure, and the data inside is as secure as the packages stacked on top of it. So if you have a package at the bottom of a stack of packages, you have to take off every subsequent package to get to the one on the bottom, which is a hassle. So the more work input on top of each subsequent block, the more secure the block overall. Now that may be a bit confusing. You may still be thinking, well, I understand that a block is just simply a collection of transactions. That makes sense. And there's blocks on top of one another, but how do we even order all of this? If you have all these people competing and putting in energy, there has to be some kind of mechanism where things get confused somewhere. And that leads perfectly into the longest chain rule. This is a fantastic question, one of my favorite components of the space. The longest chain rule. Great innovation from Satoshi. And here is a wonderful image taken from a Medium article or a Hacker Noon article, which I'll link below in the description, along with everything we're talking about here, that will help hopefully to illustrate what the longest chain rule is and how we get around it using the Bitcoin protocol, which all nodes have to follow again. So you can see here we have block 1. And this is a normal occasional forking. This is something that happens all the time, multiple times a day in the Bitcoin network. It's nothing new, it's nothing scary, and it's actually really exciting. So we have block 1, everything's good there. Someone discovered this block by solving hash, doing the act of mining, and there we have it. Block 1's discovered. Now here's our example. You could see here we have block 2 and block 2. What happened? For our example, we'll call this one on top block 2A and the one on bottom block 2B. Now let's return to our image all around the world of the Bitcoin nodes, and let's give an example. Why does this happen? Well, let's say India, over here in Mumbai, discovers a block. They solve the hash, the mathematical puzzle first. And at exactly the same time, our friends over in San Francisco, they do the exact same thing. They solve a block. Now we have a conundrum. We have Bitcoin block 2A and Bitcoin block 2B. They were both discovered at the same time. They followed the rules, but now we have two legitimate histories of the Bitcoin blockchain. How do we decide who's the legitimate history? Well, for the time being, both block 2A and block 2B are legitimate, and what we do is we wait for one of the two, whether it be India or San Francisco, to find another block. In this example, block 2A discovers another block before block 2B. Because of this, block 2A is now the longest chain with a block on top of it. Because of this, block 2B, via the protocol, the rules, is subsequently abandoned by miners, those who are trying to solve the hash, the mathematical puzzles, and all miners begin to try and solve puzzles for block 3 and create block 4 on now block 2A, which is now considered the legitimate Bitcoin blockchain. And you can see this happens again. We have block 5A and block 5B, and this continues. Now, nothing is stopping block 5B from becoming the longest chain. Let's say it finds block 6 rather than Bitcoin chain block 5A. Bit terminologically difficult there, but hopefully the visual can help to convey the fact that whoever discovers the next subsequent block fastest in a legitimate way, following the rules of the protocol, got to follow those rules, becomes the legitimate Bitcoin chain. Now again, this happens multiple times a day, all the time, not something users regularly concern themselves with. However, it does have some interesting implications. Here's what's known as a rare extended forking event. So let's say block 2A and block 2B, they discover the block at the same time, just like in our previous example, but what if they do it again, right? What if block 2A and 2B discover a block at the same time, and they do it again, and they do it again? Well, that can keep happening seemingly indefinitely. However, in the last Crypto Coffee update, if you watched, you may remember we talked about what's called probabilistic finality. Fancy words, let's break it down. Probabilistic means probability. You roll the dice, how many times you're going to hit snake eyes. Eventually you will. Statistically, you have to. Finality. This means everything is rubber stamped and final and can never be changed. Things can arguably always be changed in a blockchain and in the Bitcoin ecosystem, but we go back to probabilistically. It's a difficult one to say. Probabilistically. Eventually you have to roll snake eyes. Even if there were 100 sides to each dice, you will eventually roll snake eyes. What this means is, here in our example, at block 5, one of these two versions of the Bitcoin blockchain subsequently discovers a block first. This means all of these blocks in what is now not the longest chain, they get rejected, and all of their transactions are stuffed back into what's known as the mempool, or the collection of transactions waiting to be put in the block. Now, a savvy user may be thinking, what on earth happens to my purchase? If I bought a Lamborghini, let's say, in the spirit of Bitcoin, we bought a Lamborghini in block 4 of the now defunct shortest chain. What am I going to do? Well, this is why in last video we talked about why it is so important to wait for block confirmations relative to the purchase amount that you are trying to undertake. So, for instance, a Lamborghini owner would say, go ahead and you submit the payment and come back tomorrow and just pick up your car then. That way we have enough confirmations to where probabilistically the chain won't be reorganized and we will be assured that the transaction is probabilistically finalized. So that is the longest chain rule and how we can use this piece of the protocol or this piece of the rule set to be relatively probabilistically certain that our payments are as final as possible. So, great stuff there. Now, another fantastic question that was asked is, what is the difference between a security token and a utility token? One thing I need is a drink of water, so bear with me for a second. Great. All right, so what is a security token? What's a utility token? This is something that is a great question because the SEC is still trying to figure it out. Here's the SEC chairman, Jay Clayton. They said, "I believe every ICO I've seen is a security." Not a good look, not necessarily great. So because of this, a evolution in thinking in the space has begun to be more pointed towards the utility of a token to try and skirt the bleeding edge of what is a security in the United States. Said another way, tokens believe that if they can demonstrate clear utility on a network, an existing network, this will raise a legal argument that says, look, we have utility. That's all this is. They're like, what's the example? Chuck E. Cheese tokens. So when you think of a Chuck E. Cheese token, you don't think, well, I'm going to buy Chuck E. Cheese tokens because if the stock of Chuck E. Cheese goes up, then great, I've made money. That's not how this works. That's not how any of this works. You can only use your Chuck E. Cheese tokens to play skee-ball or get nice tickets and redeem them for prizes. They're not actually representation of actual value or stock in a company. Now, a actual security, that would be a representation of an underlying value or stock in a company. Now, here is a great wrap up. How do we actually distinguish security and utility tokens? What makes them different from one another? Well, essentially, for a asset to be named an investment or a security contract under the Howey test, which is the United States test that they put out to see whether or not an ICO is a security, they said there are 4 requirements. There has to be an investment of money. The user has to expect a return on investment or profit from the investment. The investment of money is in a common enterprise, and any profit must come from the efforts of a third party or promoter. Now, this does sound like a lot of projects we saw, and I'd imagine the SEC is working through a lot of this stuff to try and suss out what is a security, what isn't a security. But suffice to say, there's no clear answer. So this is a great, great question. One thing that's cropped up to try and help to suss out some of these difficulties and opaqueness and definitions is what's known as the SAFT agreement, or the Simple Agreement for Future Tokens. This is an attempt to try and establish a precedent on behalf of the SEC and for law in general to try and give them an idea as to how maybe to treat the space. There are 2 stages. The pre-functional stage, which is a security. That means if a network doesn't have a working network, it's more than likely a security. And 2, the post-issuance of utility tokens when the network is launched. So if there's already a network running, everything's well and good, think maybe Ethereum. They had a working network when they had their ICO. That would be considered a utility token and not a security proper. However, there has been some issues with that. This is all done under Regulation D506C for securities law. It's a security exemption specifically. However, the SEC has had some words saying that perhaps even some tokens who abide by the SAFT agreement may well be securities. So again, fantastic questions. As you know, the question was, what is a token and what is a utility token? And again, even the SEC themselves, they don't have a clear answer. Again, to cite SEC Chairman Jay Clayton from July 2017, said, "I believe every ICO I've seen is a security." And so really all of this is still up in the air. So fantastic question there. Next up we have, before we jump on to the next thing, the STO market or security tokens market. That is a attempt to try and come out and say, hey, look, we are securities. It's okay. We're going to raise money using a tokenized medium, and we are securities. It's fine. Excuse me. That's so rough. It hasn't been looking good. And this individual, Andy Singleton, is talking about how largely it's the worst of both worlds. You have to abide by all the clunky security regulations, and you don't get any or very few of the benefits that the new digital medium of blockchain and cryptocurrency can offer. So it's kind of a lose-lose situation. And really right now, many individuals in the space are just kind of biting their nails and holding their breath, waiting for some kind of guidance from these entities in the space, the CFTC, the SEC, to come out and clarify. All right, so moving on, we have, what is the Hyperledger? The Hyperledger is very, very interesting. It is supported by IBM and many, many other major institutions in the space. And here's one of the highlights. I think this is a great wrap up as to what the Hyperledger is. Not what it is, but who might want to use it. Do you want high security and true decentralization, but don't care too much about scalability? Ethereum's right for you. Do you want high scalability but don't need a broad decentralization? Then check out some of these other proof of stake blockchains. But a blockchain is not always in the headlines, but is quietly gaining massive steam as the Hyperledger Fabric. It is evangelized by IBM, as said, in the Linux Foundation, and this is a service that allows you to build your own semi-decentralized yet permissioned blockchain on the Hyperledger network. So you are not actually dealing with the level of consensus in Hyperledger. So just like we talked about mining and all the complications with hash power and that sort of thing, we don't have to deal with that here in Hyperledger. Realistically, as said, it's permissioned. So it's for enterprise level clients. Let's see if I can grab the, while we're looking for that, it's for enterprise level clients who want permissioned architecture. So realistically, this is for someone like Nike, for instance, who has a certain set of participants who will be in the network. They want to permission certain elements of the network and leave other elements with various permissions. So it's like a Discord server or something like that, in which certain permissions are given to certain individuals. Other individuals can't do certain things, and it's all handled on the back end by a third-party company. This is very different from a distributed ledger proper, very different from Bitcoin. However, there is no one-size-fits-all in blockchain technology, so Hyperledger is best thought of as kind of the corporate version of Bitcoin that companies can build on top of. I know that's not a perfect example. We could definitely get into more detail, but suffice to say, this is a back-to-basics movement, so that should be sufficient to kind of conceptualize Hyperledger. It's something that a group like Amazon would be very happy to utilize rather than Bitcoin, for example. And now we do have another question, which is, what is the Bitcoin Liquid Index? This is a great question, something that I think is very important to drive home. A Bitcoin Liquid Index is used for liquidity. It essentially establishes a price by which individuals could enter or exit a Bitcoin position with little issue. What this means is if I want to buy $6.8 million, just pull a number out of thin air, $6.8 million worth of Bitcoin, right? And I want to sell it on wherever, it doesn't matter. Well, there might not be enough liquidity for me to buy into or sell into without driving up or down the price respectively. So knowing how liquid a market is, or how much money is actually moving through a market, is very, very critical. Because I could see the price of Bitcoin at, let's say, $3,500, and I want to buy a bunch at $3,500. But if the market is not liquid and I put in my buy order, I personally could easily drive up the price to $4,500. And that's not something a large institutional investor would want to do. That's not great. And if I were to do that, for instance, then I would ultimately not be getting the best deal possible. So this is what a liquid index means. It allows you to establish how much liquidity is actually in the market and at what price to what volume you could reasonably buy an underlying digital asset. So hopefully that helps to break down what liquidity and illiquidity index is. Here's an article from Investopedia about liquidity I just wanted to pull up. It describes the degree to which an asset or security can be quickly bought or sold in a market without affecting the asset's price. So a much more succinct explanation coming out of Investopedia. I'll put this below in the description so you too can get a look at it as well. And here's the collection of questions from Tony Frank. That's the man himself. Wanted to give you a shout out, brother. Appreciate the question. The group of questions. This was great. I found this to be a great thought exercise, super healthy for me to get back into all this stuff and try to explain it in the most succinct way possible without being too overbearing and without getting off the path and getting lost in the woods of all the technical jargon and complications out there in the space. So cheers to you, Tony. Really appreciate that, man. And I hope this could help clear up some of the questions that were posed here. But yeah, guys, thanks so much for watching. Let me know what you think of this below in the comments. After all, we covered a lot of ground here, and you may have a lot more questions that stem out of this video, and that's totally natural and totally okay. Like I said, I'm very much down to answer questions. Tony's a great example of that. Cheers again to you, man. Let me know. Let me know any questions you may have, guys. I'll do my absolute best to answer them. Thanks so much for watching, guys. My name is Paul. We are Cryptide, and remember, the tide is rising, as is hopefully your understanding of some of the more nuanced definitions we have here in the crypto space.